gonna just step aside for now. And thank you so much, Howard, for providing this presentation for our group. And let me know if you guys need anything. Just if you shout Corey enough, I'll come running.
Well, thanks very much, ladies and gentlemen, for joining me today. My wife, Shelley, and I are both members of Active Adults. My background is that of a certified financial planner, a registered investment advisor. And the difference there means is I'm a fiduciary. And the purpose today is really just to provide some information and education. So I'm going to share my screen. And really wanted to talk about protecting your income and assets for retirement. Again, it's an educational seminar, and it's featuring the following topics: market volatility, protecting assets, protecting income. So let's take a look at market volatility. You know, the market goes up and the market goes down. We had a large drop in due to COVID early last year. But the way I like to think about the market volatility is think about a child with a yo-yo. Yo-yo goes up and down, right? But now the child's going up the stairs. So that's one way to think about market volatility. One of the things people sometimes do is try to time the market, try and get in and get out. And what we like to say is that it's time in the market, not timing the market. So think about this: $10,000 invested in the S&P 500, which is a broad market index, at the beginning of 2000 would have grown to $32,000 over 20 years, an average return of 6% per year. But if we miss some of the top days, it could be really costly. So what the chart shows is if you missed just 10 of those days over that period, your return becomes a little over 2.5%. You missed 20 days over that time period, now your return drops to less than 1%. And if you miss 30, just 30 of the best trading days, now you have a negative return. And over that time period, that 20 years, there's really about 5,000 trading days. So a small number of days missed could really impact the performance. What this slide shows is I want to focus on the bottom portion, and 20-year average annualized return by different types of assets. And what it shows, so real estate investment trusts and things like that. But what I really want to focus on is, let's look at the Standard & Poor's 500. Over that 20-year period, its average annual rate of return was 6.1%. But let's look further to the right and see, well, what did the average investor do? Well, the average investor returned 2.5%. And that's because they're making decisions about the market. You know, there's market volatility. And, you know, I like to say it's important to separate the emotion from the commotion and really have a plan. Some of today's retirement challenges: you may live longer than you expect. For a couple both age 65, there's a 50% chance that one spouse will live to 93. There's a 25% chance that one spouse will live to 97. So from 65 to 97, that's a pretty good, decent retirement, right? And that's, you know, retirement is, you know, I tell people the importance of saving retirement. You know, when you're retired, that's 20 years without a paycheck, right? Without a steady job income. You may not know how much to safely withdraw from your savings. Healthcare costs could continue to climb. Other costs may rise more than anticipated. And of course, the market could experience a significant drop. So we think about protecting assets. We want to reduce risk, and that means just protect from the downside. But at the same time, participate in some market growth opportunities, get market-like returns to upside potential with less exposure to market fluctuations. And of course, we want to reduce costs. And we have strategies to do that. So let's take another look at market volatility. I think, and all the fluctuations, I think the question to ask is, would you feel comfortable investing in the market if a portion could be protected from loss? So here's an example of a strategy. And what this shows is that in exchange for certain levels of protection, going down 10%, 20%, 30%, in exchange for that, you get a certain amount of upside potential. So what this shows is if investing in the S&P 500, and the example shows investing $100,000 for a 6-year period, at the end of the 6-year period, you could see, you would pick, let's say we're going to illustrate the 20% protection. So your portfolio would be protected up to 20% loss. In exchange for that, the gain would be 150% of what the market did. So for instance, let's say one scenario is the market at the end of that 6-year period, the market is down 15%. So your $100,000 investment would be at $85,000 without protection. But with protection, the first 20% of losses were covered. The portfolio would remain at $100,000. Next case, market at the end of the 6 years, S&P is down 22%. Without protection, your portfolio would be worth $78,000. But with the protection, up to 20% is covered, and it would only be a 2% loss. So your portfolio is at $98,000. On the upside, in exchange, remember we said in exchange for some downside protection, on the upside, there's going to be some limit on the upside. So next scenario, market's up 65%. $100,000 would become $165,000. And because the upper cap is 150%, you would get all the $165,000. Next scenario, market's up 200%. So $100,000 would grow to $300,000. But because you opted for some protection on the downside in exchange for that, the upside is limited to 150%. Not bad, but your portfolio is at $250,000. So that's just an example of a strategy to implement. Gives you both upside and downside protection. We'll look at historical index returns. For this period, 1989 December to 2019 December, let's look at the S&P 500. So over those 6-year rolling periods on a monthly basis, the number of gains for those periods would be 246. So over those 6-year rolling periods, market was up 246 times. Number of losses were 43. So when we looked at the details of the 43 periods where there was a loss less than or equal to 10% was 32. Loss of 10 to 20%, only 11. So for that period, there were no losses between 20 to 30% or greater than or equal to 30%. So, that just shows you just some historical perspective on the percentage of losses that one could have seen over a 6-year period. We think about protecting income. I guess the question is your retirement income insured. Here's some assets, a home, for instance. The value is, we have a certain value on that, and we insure it. This just shows odds of a major fire damage in the next 30 years, less than 1%. But we do insure our homes. We want to protect that, right? Our lives, life insurance, probability of 60-year-old male dying within 5 years, less than 4%. So we insure our lives, right? Many times people feel that the home is the most important asset. I believe that one's ability to earn income is the most important asset, and that's why life insurance is very important. Autos, we protect our autos, right? But what about 401ks, IRAs, and other retirement investments? Do we have protection for those? Historically, the market has experienced a decline, once every 3 to 4 years. So when we think about protecting our income, we think it should be protected just like we protect some of our other important assets. There's been a lot of literature about determining a safe withdrawal rate. One long-standing rule for generating income from a retirement portfolio is known as the 4% rule, but that rule may no longer be available. And I remember hearing about that 4% rule when it was first put forth by a noted certified financial planner in San Diego. So what this shows is, assuming a 4% initial rate and an unprotected portfolio allocated 60% stocks and 40% bonds, it's what we call a balanced portfolio, there would be a 19% chance that the portfolio would fail to provide lasting income over a 35-year retirement. And what they mean by unprotected portfolio is that the portfolio does not include a lifetime income guarantee. So there's the 4%, and where the 19% comes in is this chart is showing an 81% success rate for that 60-40 portfolio, withdrawing 4%, lasting that 35-year retirement. So 81% success translate to a 19% chance of not meeting the needs. A recent survey of the goals most important to people planning for retirement, having enough money to last for a lifetime, was number one. You can see some of the other things on their survey as well. Remaining financially independent, stay and live in their own home. But have enough money to last their lifetime was number one. When you think about protecting income, we want to create a strategy for a longer life. Today, we're living longer, and your income strategy should provide income for as long as you need it. Keeping your income growing. Important for retirees to address inflation and the effects it can have, on their investment returns, purchasing power, and the longevity of a portfolio. Purchasing power gets to the topic of inflation. We may have cash, but if inflation is growing and we don't have something to protect us from that inflation or to grow a little bit, then we're going to start to lose purchasing power. And prepare for market volatility. Your income strategy should provide a level of protection from market returns. A little bit about our firm. The name of our firm is Primerica. We're the largest independent financial services marketing company in North America with 130,000 licensed representatives. What that long sentence means is that in terms of representatives, there's nobody bigger than us. We are listed on the New York Stock Exchange. Only the top companies get to do that. We are a $5 billion company. We've been in business since 1977. So we're in our 44th year. So we didn't just start. We've been around quite a while. Approximately 5 million lives insured with Primerica and approximately 2.5 million investment clients. Some of our accolades: Forbes ranked us among the 50 most trustworthy financial companies in America. Actually, we're ranked 13th overall, but number 1 in our size category, the mid-size category. We're in the Fortune 1000. That just happened in 2020, so we're very proud of that. We are extremely proud that Forbes ranked us among the best employers for women in 2019. Our life insurance company, we own our own life insurance company. It started in 1929. We are rated A+ by A&M Best, and less than 10% of the companies get that level of ranking. It's just an idea. Some of the companies we work with, I think we're sort of like the Amazon of financial services. And these are some of the companies we work with and represent. Well, Primerica Life, that's our own life insurance. We own our life insurance company. 401k plans that we help companies with, American Funds, Voya. On the annuity side, Lincoln Financial Group, AIG, Bright House. Manage investments, Primerica Advisors, we manage investments for those in that. Mutual funds, American Funds, Legg Mason, Franklin Templeton. You may have heard of some of these. They've been around a long time. We only work with the best companies. Legal identity protection, ID theft defense program. We have Primerica Legal Protection Program that helps with wills, living wills, powers of attorney, things that are very important. Mortgages, we partner with Quicken Mortgage. So they help with refinances and new purchases. Auto and home, we partner with Answer Financial. So we help people we take who a person's with in terms of their auto and home insurance, and we can quote across 20 A-rated carriers. And very quickly, either they can save you some money, or maybe they can't, but at least that you've got great coverage. Vivint Smart Home, that's home security, home automation. You might ask, well, why would we partner with a company that does that? Well, they rated in 2019 among the best home automation, but also we find that because we work with people on their home insurance, that having a security system saves them money. There's my contact information. And our offices are over at Anderson Mill and 620. If in a non-COVID environment, we would be hosting at our offices. But in this Zoom world, this is how things are done. And there's my phone number, and that's the website. And so if you took a snapshot of that, that's great. So I would like to, that was a lot of information, but I'd like it to open it up to any questions.
I'm pretty comfortable with regard to the investments that I've made, the diversity that exists. I'm familiar with the volatility that is inherent in investment. My greater concern, and I didn't know what to anticipate of this presentation, is the tax picture and how you take the investments, the money that you've made, which is untaxed money, and then protect it so that you're not paying so much taxes.
Well, there are some strategies there. Maybe move a portion of it to since it's been in a tax protected environment all this time. One of the things to do is maybe move a portion of it to an investment that doesn't have taxes, like a Roth IRA. There'd be no taxes when those distributions come out. And but I will point out that when you do that, you're going to have to pay some tax at the time of conversion. So it's a matter of looking at what your tax picture is, and maybe doing a partial conversion over time. One certainly wouldn't want to put the entire portion into a Roth IRA, because then you might have a big tax hit. But to do it over a certain number of years, sometimes that might be a good strategy, and that would save on taxes.
Okay, thank you.
And if it's always it might be a good idea. Yeah, you said you're comfortable with what you have on the investment side and the diversification. It's always a good idea to maybe have a second look and see if there are some things that could benefit you in terms of that. Maybe protecting on the protection of the income side, or protection of the assets. Again, with maybe a portion of your portfolio, at least knowing that some portion is protected.
And we have moved some things. We meet at least quarterly, and so some things have been shifted around to help at least.
Okay, so you have some assets that are going to protect from downside loss.
Absolutely.
Okay,
that's the plan, at least. We'll see.
Okay. Yeah,
that iffy at this time of year. I start to get antsy about it.
Yeah, well, that's the benefit of having, knowing that a portion is protected. That if the market goes down 10% or it goes down 20%, you're not going to lose 20%.
Oh yeah,
it'll be guaranteed.
We're protected. That I'm sure of.
Okay, great.
Yeah, no, I'm pretty comfortable with the way things have worked. All through COVID, when we had that rock bottom, I was okay. It didn't, and everything now has recovered dramatically, which is
right. Yeah, it came back precipitously, right? And so that's why studies show that a significant number of people got completely out of the market. And if you have some protection, some strategy. You mentioned diversification. That's great. You want to have some of that. And so, but that's why there's some strategies to help protect and limit the loss. Because we do it. I tried to show that some of the other things we do that we really have. It's not just investments. It's a broad array of financial services.
Right.
Any other questions? Those are great questions.
Not related really to that. And when you mentioned all of the other services, it made me laugh. My home warranty is almost ending. And I'm just debating about whether to invest in those payments each year toward either a home protection program or just specific. I have GE appliances. Do I go ahead and renew that?
Oh, I see.
So it's just general protection. It has nothing really to do with long-term investment. When you said that, it made me think of it.
Yeah, well, that's a trade-off, right, Linda? Whether you invest in that or you have some investments or, an emergency. When we work with clients, we do what's called a financial needs analysis. And that includes, setting up an emergency plan, an emergency bucket to make sure they have the funds to cover those short-term emergencies, which just do happen. So, that's one of the things when we work with families, we put that together. Financial needs analysis, it's sort of like a GPS.
Yes.
If we're going to get in the car, we're going to drive to Disneyland. I think you can still get in. It's like, without a GPS, we'd get lost, right? But with a financial needs analysis, it's sort of like a financial GPS. Helps families understand where they are and how to get to where they want to go. So yes, what we're talking about today was about retirement mainly, but we do a lot more than just that for families. And we're going to have another workshop coming up that talks about general financial wellness, not
Mhm.
just geared toward a retirement.
Gotcha. Well, thank you very much. I appreciate your time and your information.
Thank you very much. You have my contact. You have any questions at all, please feel free to call.
All right, terrific. Well, thank you so much. You take care.
Thank you very much.
Linda.
Nice to see you, Shelley. Bye-bye.
Bye.
Did you have a